everybody can see my screen here. Again, welcome to our seminar. Again, apologize for some technical difficulties that we had here. The topic of our seminar today is just kind of looking at your overall retirement and finding out if you're ready to retire. There's lots of things that we need to do in order to prepare yourselves for retirement so that the process is stress-free and smooth, and obviously gives you a little bit of a peace of mind as well too. So as we go through these, we have on the screen here, if you wanted to scan this QR code, you're welcome to. It'll take you to a little contact sheet where you can fill out a request for somebody to reach out to you. You're always welcome to go to our website as well to contact us for an introductory discussion as well too. So here for the seminar, I do have the chat box open. So if you have any questions, please feel free to use that chat box, and I'll be more than happy to answer those as I see them come in. Again, welcome to the seminar. My name is Misty Garza. I am one of the financial advisors here out of the Houston office. So a little bit about Bogart for some of you who are new to our firm. We were founded in 2016 officially as Bogart Wealth. We have 3 offices, 2 in the Texas location, and our headquarters is in McLean, Virginia. We have about $3.1 billion in assets under management, about 1,400 households. And now we've grown over the last couple of years to over 50 employees as well too here at the firm. So let's talk a little bit about the agenda today for our webinar. We're going to talk a little bit about the retirement risks that we are faced with, go through the retirement income planning process, which is partly going into a retirement analysis. What does that look like for people? What kind of investment strategies are out there? The withdrawal strategies, which are very important to replicate your paycheck, basically, of how do I retire? And then, of course, reviewing and monitoring the progress. What does that look like? And one of them that I think is definitely more important is dealing with emotions and all of that as you're going through this, whether it can be leading up to retirement and then actually through the retirement process as well, too. Those emotions can change. So first and foremost, let's talk about why is a plan important. A plan is very important because we need to know what retirement is going to somewhat look like. Now, I think sometimes people feel that they need to know all of the answers to their plan, and you're not going to know all of the answers because it can change a little bit when you get into retirement with whatever your goals and hobbies might be, or what your life might look like. You might want to move from where you're currently at, but you don't know that until a couple of years down the road. So your goals change, your lifestyle changes. And so what we try to do is we want you to kind of have an idea of a plan so that we can put something together with the process so that we can make some retirement decisions that are the financial ones that are kind of irrevocable sometimes for those. So we want to make sure that we're basing those decisions on the actual data that we have for retirement and not just on emotions. When we're planning for that cash flow, if we feel good about the numbers and what our plan is, then it does give us some peace of mind and some confidence, and so that we don't stress too much about what the market is doing. Am I going to run out of money? Am I going to have to go back to work as well too? Because it's very different when you're in the accumulation phase of working versus actually the spending phase and the de-accumulation phase that people go through in retirement. And that can add some additional stress if we don't feel confident and comfortable in our retirement plan. So the plan is there to give you that confidence. And part of that helps us when we know what your plan looks like. That's where we create the investment strategy. If we don't know what your goals are, what you're going to need in retirement, then we can't really build out those investment proposals for you accurately. And again, part of that then leads to when we create those investment strategies, how do we recreate that paycheck? What does our spending look like? How do I pre-plan if there is a market downturn, or if I'm faced with a medical situation or family issues that I need to help support? So kind of having all of that data there can help us plan for the unexpected as well too. Again, I think ultimately it is to reduce your stress and put you a little bit more at peace with that as well too. So Kind of getting into the details of, why would you do retirement planning? It really is just to minimize all the risks, right? Of going into retirement and making sure that we don't have to go back to work. I think that's one of the biggest concerns that a lot of people have. And so we want you to make informed decisions about your retirement. When people are looking at how much can I spend? Do I take the lump sum option versus the annuity? Can I travel more? Can I buy a second home? Right? Like those are all the decisions that we want to be very informed about. And so we want to have all of that in the system so that we can run different scenarios for you to help outline that path for you. It also gives you income that some people want to know that I know how I'm going to pay the bills every month on there. For some people, we want, if their goal is to spend every single dollar and leave nothing behind, or if it is to leave a legacy behind to our family, then kind of creating whatever that withdrawal rate needs to be for you. Like all of that is encompassed within that retirement plan. And then, of course, we monitor that. When we do these retirement plans, it's not a one-time shot that we go in, put it together, and we hope that we picked all of the right things. It's always something that's moving because, like I mentioned, you don't necessarily know all of the answers, or you might even think you do know all of the answers, but then something changes. So we always is important to reevaluate your overall plan every year just to make sure that we're staying on track, as well as maybe we planned for a certain level of withdrawal rate and we're either above or below that, or maybe the market has done better or worse than we thought. So having all of that income plan will allow us to make all of those educated decisions about moving forward in retirement. So some of the things to kind of think about when you're putting your plan together, it's really what is important to you. We've done so many of these, and so they're all different for people. So when we look at some of these plans when we're putting together, obviously we're a great resource to say these are some things other people have looked at, but not everybody has the same goals. So this is not something that you talk to your neighbor about and say, what does your retirement plan look like? From an income standpoint, or how are you funding your retirement? Because they may or may not have as much as you, and they might be have a different lifestyle than you. They might want to leave money behind or not. So part of that plan that we look at in creating those solutions for you is, looking at these issues. Some are more important to you. Some might not be important now, but might come in later on. So again, looking at your overall family, what does that look like from the family dynamics there, your health, making sure that as you enter retirement, that you do stay on top of on every day is a Saturday. What does it look like for you? That can be a huge adjustment for a lot of people. And so that can affect people mentally as well as physically, and then have some repercussions later on in life as well too. For that, where do you plan to live in retirement, right? Are you going to stay where you currently live? Are you going to relocate to another state outside the country? Lots of different things that people are faced with on there. Lifestyle, again, we talk about what are you going to do every day, right? So sometimes people have certain hobbies that they love. Sometimes they don't know what they're going to do, and it's important to find out how are you going to spend your day as well. Work, a lot of people do go back to work. Their intentions with starting out their financial plan is immediately that they're going to work part-time, or at least at their leisure, on their own time and schedule that they want to. And sometimes people retire and then realize that they want to fill their day by going back to work. And that could either be something that brings in a decent amount of income to you, or it could be something that's fun, but you don't make a lot, but it is something that does come into the overall picture as well. Legacy, we talked a little bit about that as far as, do we want to spend it all? Do we want to leave something behind? Do we want to help our children and family members while we're retired as well, before we pass away? Again, those are the kind of the topics as we're working through the plan to find out what's most important to you and your family so that we can help build out that plan specifically for you as well. So when we think about what some of the greatest retirement concerns are, I think most people will agree with where these numbers are. I think that one of the biggest concerns that that retirees have is whether or not you outlive your savings. Now, initially, you'll see this is over 50 is the light blue for people, essentially, it's say pre-retirement versus when you are retired. So you can kind of see it does change potentially once you hit retirement and what your concerns might be. And I think there is an adjustment phase when people retire. I think initially the first, couple of years, somebody might have that concern of running out of money because this is new to them with that decumulation phase. But I think once you get into retirement, people get a little bit of comfort and confidence with their plan. And then some of these other things kind of start to creep in, whether it's Social Security, if it's declining health, long-term care costs. Those are a lot of the issues that we're faced with people to help them understand how do I best plan for something like that if it were to happen there. You will see, I think that a lot of these become very much more health related with declining health, long-term care, losing my independence, cognitive decline. That typically seems to be one of the bigger concerns. And so we figure out how to address that within your plan so that that becomes not as big of a concern for you. And again, giving you that peace of mind as well too. So when we think a little bit about what are some of the true risks in retirement that we look at as planners here. And so we address all of these within our financial analysis. And again, they're all different depending on your specific situation. Longevity. When we typically run these plans, we run them usually until 90 for most individuals, unless there is a history of people even living longer. So statistically, the average couple that's age 65, 42% chance that one of them is going to live to age 90. So at least one of the two people, if you are married, are going to live until 90. So we do have potentially a risk of longevity. And that comes in based upon, what our withdrawal rate is, what our assets are doing, what the market is doing as well too. So managing all of that to make sure that we don't run out of money there. Now, inflation, none of us can really get around inflation. So that's just really making sure that it's built into the plan. And there are costs, healthcare costs are rising much faster than traditional expenses there too. So we will break down when we're doing the planning with your current expenses as well as healthcare costs that we want to put in at some different inflation rates. But retirement planning is very sensitive to inflation. That doesn't mean we need to go in and increase the inflation numbers to be 10% or something like that. So we definitely want to look at the long-term averages of inflation, staying around 3%. And so that's normally what we're looking at potentially in these plans as well. Obviously, the market performance is a given, depending on what our overall portfolio looks like. The sequence of returns is very important for individuals. And what the sequence of returns talks about is that if the market loses value in the first couple of years of retirement, it's have much more power over that versus losing a substantial amount when you're 90, right? Your withdrawal rate could be very manageable at 3 or 4% when you first retire, but if the stock market dropped 50%, your withdrawal rate now is more like potentially 7, 8, maybe 10% or something like that. So that's what the sequence of returns is. So one of the ways to think about that is how do we avoid those market risks and those sequence of returns when we're creating your plan? And all of that comes into the investment strategy. And we'll talk about that a little bit later on as well too, and how to help eliminate some of that. Healthcare costs, obviously, of a concern for people, and we can build those in for individuals, whether they are, they can cover those costs by being self-insured, or if there are other ways to cover those costs if it is important to them. So talk a little bit about one of those, which is the spending, of some of those risks that we have. When we're looking at a plan, a lot of times I'll find that people have never really had to budget. The idea of budgeting is just kind of like restricting people of what are you spending, where you want to know where everything is. And it's really important when we go into retirement to put your numbers down on paper, because when you're typically just, living on your paycheck that's coming in, you sometimes feel the freedom to not have to worry about it. You just know what you have for the month and you spend it, and that's all fine. But what we'll find is that in retirement, sometimes people might spend a little bit more, right? You have more travel costs, certain things will go away, but then there could be certain things that could come on. So it's very important to understand what your costs are so that we can properly plan for what that's going to look like and how we need to protect your portfolio from all of the other things that we just talked about on there. So We always ask that people put down their expenses, and we'll typically break them up into these two categories: essential expenses and discretionary expenses. And it's important to kind of know the difference. So essential is, keeping the lights on, paying the rent, the mortgage, the property taxes, the insurance, all of that kind of stuff, the things that you need on a monthly or annual basis, keeping your roof over your head. The discretionary expenses are all the things that could go away if need be. And so when we're working on creating your analysis, part of it can be if we want to have our investments cover all of our essential expenses, and then everything extra can come from a different source. Lots of ways to kind of do that, but it's nice to know that if I was faced with the worst case scenario, what do I need to keep on a monthly basis to keep the roof over my head and do all of that. Also, how much do I need to set aside for emergencies or unexpected expenses? Now, this is different than having an emergency fund. While we're working, typically we want to have money in checking or savings as an emergency fund in case something were to come up. And the logic behind that really is because most of our assets we can't touch. They were in our 401k, they were in our pension, or they're in some form of a retirement account. And so I either don't have access to them at all, or if I do have access, then I have to pay some penalties to tap into them. That's what we're looking at for emergency funds pre-retirement. Once we are retired, we look at it in a different situation. It's not an emergency fund in that sense. It's more of if I did have an unexpected expense come up, whether it's some home maintenance or a medical expense or something like that, just making sure that we have properly planned for those kind of things that would come up so that we wouldn't have to tap into funds that maybe if the market is down or something like that. So part of that is figuring out, again, what does that look like from a spending level? And then the last one is, do you increase your income annually for a cost of living adjustment? When we do our planning, our plans assume that every year you get that inflation adjustment every year in the analysis. Now, what I find that really truly happens is every January, we don't go in and increase everybody's monthly withdrawal into their bank account. But that's what the plan's assuming. What we found is typically happens is we set up a monthly draw. Let's just say it's $10,000 a month coming into your account because that's supposed to cover all of your expenses. Usually, maybe a year or two, maybe even longer down the road, suddenly somebody's like, you know what, that $10,000 isn't covering it anymore. Can I have a little bit more at that time? And I've seen that going all the way through, like even COVID, when we had after 2020, when we had a drastic increase in expenses and things cost a lot more, people just kind of absorbed a lot of those inflation hedges and all of those increases. And then at some point it became a little too much. And that's where people kind of said, okay, I think I need a little bit more. Or if they're calling for some extra expenses to pay their annual property taxes or insurance or something like that. That's normally how it truly works. But it is important to make sure from a planning perspective that we do assume that your expenses do go up. And some might fall off later on in life as well, too. So that definitely changes as well. So this kind of reflects a little bit about what people can be faced with at different ages and what their spending pattern looks like. So you can see, obviously, the younger you are, typically your expenses are a little bit more. We'll typically call them the go-go phase. And then we have the slow go where your expenses slow down a little bit, and then the no-go phase. That's usually the projection for a lot of people, just because you're less active. Now, what you will see is that the healthcare costs are going up through this period of time. And that truly is accurate. And so as healthcare becomes potentially more and more expensive every year and a little bit out of our control, we do find that typically going into retirement, that is the one biggest expense that people have, and that sometimes are surprised on how much that can be. So it's very important to look at your situation, look at your healthcare costs. Are yours more on average? Are they a little bit more, ahead of what the average person spends? If you do a lot of additional things, personal training, acupuncture, all those functional medicine type of things there, then maybe your expenses are a little bit more. So we definitely build those in and have those conversations about what are some of the things within your budget and your spending plan that may or may not be accurate on there. We can tell, we've done this long enough that we can look at people's expenses and sometimes say, okay, does this look good? Or if I feel that there might be missing something, then we're going to have those conversations, because we don't want to have a whole lot of surprises on the back end. And again, that's why we ask for people to write them down, look at what it is. And that can be very eye-opening for people because a lot of times people don't realize what they're spending until they actually put it on paper. And that can either lead for you to be a little bit more cognizant of what you're spending, or if you did need to make cuts, it's an easy way for us to look at what could come off the budget if need be at a time. So let's talk a little bit about the retirement income planning process for us. One of the things that we do is we do the retirement analysis, which is all of that budgeting and the spending analysis that we put in, all of your goals that we have in there. And the analysis basically just tells us, can I retire? Can I have the lifestyle that I want? What does it look like from there? It doesn't really tell you how to do it. So then once we have that analysis that says, yes, everything looks good, then we take a step back and look at that investment and withdrawal strategy and say, okay, well, everything looks good, but how do I do it? And so part of that investment strategy mix is going to be based upon your comfort level with risk and what your goals are. If your goal only needs to be 5% rate of return to be successful, then that lets us know that we may or may not want to be a growth or aggressive growth investor if that's not what your comfort level is. If your portfolio says you need to have, a 6% rate of return to be successful, then again, that's how we can create that plan. And part of that, when we're creating those investments, is where the withdrawal strategy comes in as well, too, to make sure that those investments match what we are wanting to do with that withdrawal strategy. After we've done those things, then it's continuously monitoring and reviewing that process. Again, like I said, we don't necessarily have all of the answers, or even if we think we have all of the answers creating this plan, it's going to change. Market's going to change. Your comfort levels with risk may or may not change, and your goals may change. And so a lot of times, as we potentially solidify what our plan looks like, I want to have a good base plan going into retirement and feel really good about it, and then tweak it as needed. If somebody suddenly says, hey, I want to buy a second home, then we've already done some of the base planning. We can run some quick analysis to say, okay, yes, that works. So here's how much you can spend for that second home. Or I started traveling the first year of retirement and I think I want to travel more. What can I do? So those are the kind of reviews that we'll do within those analysis as well, too, just to make sure that we keep a current one. Again, depending on how your situation changes, you could do this on an annual basis as needed, or we could just do it on, 2 years. If I have a really good solid base plan and nothing has really changed, then we just can monitor where we're at. The initial plan will tell us where we need to be at the end of year 1, at the end of year 2, if there haven't been any substantial changes. So that's anything that moves off of that would be when we could do an update on that analysis as well. So again, as we're kind of looking at that plan there, prioritizing your lifestyle, your realistic expectations for achieving them, again, depending on what your goals are, making sure that we have an accurate reflection of what we think retirement is going to look like. Again, we've talked a little bit about these expenses here on breaking them up as well, too. If I don't have good data coming into this initial retirement analysis, then we're not going to feel comfortable about what the outputs are or what the recommendations are there too. So when we think about some of the other things outside of the budgeting that comes into the analysis, we talked a little bit about the healthcare and the inflation numbers that we use. We're also going to look at other income sources that somebody might have in their situation. So Social Security, employer pensions, whether they're the lump sum or the annuity option, any other personal savings and investments that you have outside of that, rental business income, part-time employment goes into that analysis as well too. So when we think about going a little bit more in depth of what these sources of retirement income looks like, Social Security is a huge piece for a lot of people. I don't know that people realize how much Social Security comes into play later on in life. When we do these analysis, depending on the age, typically anybody who's over 50, we're always including Social Security into the analysis. And it replaces, a substantial amount sometimes for some people. We will look at the appropriate timing for Social Security as well, too, depending on whether you take it early versus at 70 when the benefit maxes out. We'll help walk you through what all of those decisions are and how that impacts your overall cash flow as well, too. But for a lot of individuals, Social Security replaces a huge part of it. Of course, the pension as well too, whether that is, again, like I said, taking the annuity or taking the lump sum, and also which option is better. So for some people, if they have the choice between a lump sum versus an annuity, what makes the most sense for you as well too? What does the plan look like? And then of course, we'll bring in any of your additional savings and investments for all of that retirement income. So talk a little bit about the investment strategy piece of that. There's lots of different ways from investments. Once somebody is looking to retire or they do retire from their company, a lot of times the world of investment options opens up to a lot of things that you've never had access to, because a lot of individuals have the bulk of their money in a pension or in their 401k, and their options are limited. So part of this strategy, we'll go through a few of the options, and these can be good at certain times. These could not be good at all for a certain individual, depending on what their preferences and what their goals look like. But we look at some of the different elements of what some of your options are. Annuities are an option. You can actually consider a pension as part of that as well too, right? That would be a fixed annuity. You have that as a fixed income coming in over your lifetime. Bond ladders, other income-oriented investments, dividend-paying stocks, things of that nature. Fixed asset allocation is where you figure out what your mix is and you just kind of rebalance. If you're a 60-40 mix, you just rebalance to 60-40 all the time. Dynamic asset allocation is where, if my goal is to potentially have a 60-40 mix, maybe there's certain times to where I want to be 65-35, or kind of looking overall at the market and not just having the solid fixed allocation that I've set out as well too. So let's take a look at a little bit of each one of these as well too. So from an annuity perspective, there's typically three types of annuities. You have fixed, index, and variables. Fixed are like a CD, right? You put your money in, they're going to give you a certain interest rate or a certain monthly payment fixed for life, and it's not going to change based upon what's going on in the market. You do more of an indexed annuity, and that's going to be linked to some form of the stock market, whether it could be 100% of the S&P 500, it could be a blended index, but basically the idea is that it's going to be proportionally return of whatever that index is. So you do potentially have some risk associated with it, to lose money, to gain money, depending on that contract there. And then variable is kind of like a normal mutual fund that you might buy. You're basically essentially participating in the full upside of whatever that investment is, but it does defer those gains, and you could have limited choices. So you don't have everything in your toolbox there from a variable standpoint. Those insurance companies have some restrictions on what you can buy. Think a little bit about bond ladders. Again, bond ladders and all of these are basically depending on what's going on in the market and what your goals are. So a bond ladder typically would be, you buy 5 different bonds. You buy a 1, 2, 3, 4, 5 year bond, and you typically spend down that year. So this is how you could set up a withdrawal to say, I'm going to put 1 year's worth of expenses in a 1-year bond. That's going to come due. I'm going to live off of it. And then in year 2, my next bond came due. I'm going to live off of it. So the idea would be creating potentially this bond ladder to cover a certain period of time for your annual expenses. Again, this is very much based on, is this appropriate given the current interest rates, given the current environment, given your overall risk tolerance as well too. But it is something that when we're thinking of all the different ways to create that income and create that investment strategy for you, these are the things that we're looking at as well too. The biggest one, obviously, that a lot of people look at is just more growth oriented versus the dividend paying type of strategy. But typically, sometimes we'll call it more income only strategy. And it doesn't have to be income only for your full portfolio. It could be a portion of your portfolio. When we talked earlier about having your essential expenses and your discretionary expenses and the extra for that, a lot of times people want to know that their essential expenses are covered by that. And one of the ways to do that would be to make sure that you have a guaranteed income stream that covers those essential expenses. So whether that's a pension or an annuity, or an income producing type of investment like a dividend paying stock or something like that. And so what we found is obviously the growth oriented, typically not paying you any income, those are a little more long-term investments versus the income oriented investments, dividend paying stocks, things of that nature that are paying out a percentage every year. So part of this could be important to somebody's overall mix if they like the idea of having some sort of guaranteed income. Now, dividend paying stocks, obviously there's no guarantees, but if you have, if somebody is managing that portfolio or you have a stock that you're paying attention to and making sure that those companies can continue to pay those dividends, that's what we're looking at here. So over time, they end up getting to the same situation, to the same place at the end, but it just depends on what you're wanting that withdrawal strategy to look like. If you want to collect the income now, great. If you don't, then maybe more of a growth strategy works better for you. Oops. So this is just a slide just to kind of give you an idea of all of those things that we talked about, why they're important when we're creating the overall investment strategy for you. Because what you'll see is that this is showing all the different sectors of the market and which ones perform better. If we knew what was always going to be at the top or what was always going to be at the bottom, it would be very easy to pick and choose your investments every year. But because it's always different, what was the number one performer, this is why your investment portfolio and your asset allocation mix is very important to your overall success of your plan and making sure that that is being managed appropriately there too. So let's talk a little bit about the withdrawal strategy here and kind of what that looks like. So I talked a little bit about the income only strategy with using dividend paying investments. So again, just looking at setting money aside, it spins off the dividend. Now that could be at some point in time when money markets and CDs are paying 5.5%, right? That's an income strategy. That's a decent rate of return. They're not paying that right now. So those kind of things are not necessarily on the income side, but that income only piece can change over time depending on what the overall market is doing. But typically we'll assume income only is pensions and annuities and investments that spin off a little bit of higher rate of return of, maybe around 4% or so from a dividend yield. Systematic withdrawals is where we basically have an account set up. Let's just say we have a moderately invested portfolio and you need $10,000 a month. We just put it in that bucket and we send you $10,000 a month. It's important to look at that one and make sure that that overall investment mix can sustain your withdrawal rate. Because if it is invested too aggressively, this is where that sequence of returns comes into play. If it's invested too aggressively and that portfolio suddenly drops 10 or 15%, we need to make sure that it can withstand whatever those income needs are as well. And then the last one is the bucket approach, which kind of helps with that sequence of return and those systematic withdrawals by actually looking at your overall cash flow plan over a period of time. Typically, I like to look at a 10-year cash flow plan. And so we want to look at what our needs are for those 10 years. And again, they could change. We could be spending a little bit more in the first couple of years. And then we could be spending a little bit less by the time we get to year 10. But the idea is that if we have a shorter time to be able to access these funds, I need them to be a little bit more immune to what's going on in the market. And so if I have investments in those first couple of years that are not going to be subject to the fluctuations of the market, that's how I get out of the sequence of return risk that we have. I'm not having to sell at a loss. And so everybody's different as far as what their plan looks like and what their comfort level is. Some people might just have 2 years of something in a very conservative investment. Maybe for my conservative investors, they might want 5 years, right? So everybody's bucket approach could look different. There's not a one size fits all. Again, depends on what your situation looks like and your comfort level. But I do find sometimes that like an income only and a bucket approach helps alleviate a lot of the fear and the concern of running out of money there for a lot of individuals, especially in the early part of retirement as it's all new and you're not really sure with kind of the outlook of what the market is doing and the fear, I think, of a market pullback. Those help address that. All right, so let's take a little bit, show some examples of specifically how this works here, just to kind of solidify so you understand how we would do that. So in income only strategies, let's just say somebody has $1.5 million and they need about $5,000 a month, so $60,000 a year. Again, you could do something to where Social Security is drawing down about $24,000 a year. This could be also a pension or something as well too. That could be added here. We could do a bond ladder with some CDs, some money market accounts, things of that nature that we could invest here as well to give you some income. And then we have a dividend paying stocks here on the back end that's doing that. Again, you could potentially do one or the other. You can change all of this. This just kind of gives you an idea of currently, what would that situation look like? Now, if somebody had a higher need off of that, then a lot of these could change as well too, as far as where we would put some of this money here. The systematic withdrawals, like I said, we have the same amount of money here, but we're just basically putting it in one type of portfolio and just pulling down that money that you need on an annual basis or on a monthly basis. Again, this one's subject to market performance, so it is important to know what's going on. And this could just be, there could be two buckets to this where you could have two different portfolios as well too. But the idea is to just pull it down from that bucket. And then if we look at the bucket approach that we talked about of creating this long-term cash flow plan, if we know that we need 5 years worth of income, if we're spending $60,000 a year, so this first bucket needs to have about $300,000, right? Typically in this situation, we're doing something conservative, something that is almost risk-free from there. So we're putting $300,000 into something like a money market account, high-grade bonds. Again, very dependent upon where the market is, what this looks like as well, but the goal would be very little fluctuation. And then we look at this mid-range bucket. Doesn't have to be 6 to 12. This could be 4 through 7 for some people. But in this situation here, we're saying definitely more of a long-term middle ground bucket here. So if we know we're going to need $400,000, what do we put in to create that need here? So we're typically going to do, again, a little bit more of a moderate, so some bonds, trickle in a little bit of stocks there, because we definitely want to make sure we're keeping up with inflation. The idea is we're using all of bucket 1, and then we go to bucket 2 during that period of time. And then bucket 3 is our long-term bucket. Now, during this period of time, we could be refilling bucket 1 as well too. So as we use up year 1, we'd have 4 years left. So we look at it and say, am I okay with that? Do I want to replenish that? And that could either come from bucket 2 or 3, depending on what the market is doing. I always like to take gains while you have them. So let's say you used up the first year of bucket 1 and the market did really well. And so your bucket 3 earned way more than we ever thought. We'll take the gains while we have them. So we sell off, replenish one of the years that we need. The market didn't do well, then our bucket 2 probably performed better than the other one. And so we might want to move part of bucket 2 into bucket 1. But this is the idea to help alleviate any market risk that we have. Okay, so if we look at, there's always a lot of concerns of, you always hear of a safe withdrawal rate for a lot of people, and usually 4% is the number that is floated around here. So one of the things to think about is that 4%, depending on how old you are when 4% starts, right? 4% for people who are 55 plus basically means you're going to have enough money throughout your retirement for about 43 years on there. Give a 3% withdrawal rate. It is assuming we are growing our money. We're not parking it in cash and leaving it there. So it is assuming a 5% investment return and inflation there. But you really don't outlive your money. The higher your withdrawal rate, obviously less years potentially that you have. Now, what we will find is that as Social Security might come in later on in life, so somebody is retiring a little bit earlier and they choose not to take Social Security until 67 or something like that, then your withdrawal rate could be a lot higher as we're bridging that gap before Social Security. And our plans will let us know what that looks like. This would just be assuming that the long-term withdrawal rate could not sustain some of these shorter periods of time as well too. So very quickly, you can look at if the market performs still good, but inflation creeps up, right? So somebody says, well, what if inflation really changes over the next couple of years? Does that really impact it? Not really, right? Like it's still, because you still have basically the same amount of time there. So that withdrawal rate will typically hold up through all of that period of time. So talk a little bit about how do you recreate that paycheck? How do you look at managing some of those distributions in retirement there? One of the things that we look at is the tax status. So you have non-qualified accounts, which is going to be your non-IRA accounts, your brokerage accounts, cash savings, things like that. You have traditional IRAs, you have Roth. When we're looking at creating that withdrawal strategy, one of the things that we look at is obviously tax planning today, as well as tax planning in the future. And not necessarily tax planning on what are we doing right now. That's part of it, of what tax bracket you're in, but it's also about what does the future look like at 75 or something like that? Play into that. And I see a question did come in about how does income tax higher and capital gains tax play into the selection and choices? Kind of part of this, right? When we think about our cash flow planning, we start out the plan based upon what the taxes are today and what the brackets are today. But on an annual basis, when we are looking at what your spending is, your plan, when we create them, I think is important for your plan to be flexible. Because as tax laws do change, as investments change, the market changes, we want to be able to pivot and switch if need be, if something is more favorable or not. So when we look at tax planning on what capital gains are and where things are, a lot of it, when we put your plan there, will be determined on what your spending is and where your assets are. A lot of people might have everything in their traditional IRAs or their 401k. And so at that point in time, we don't really have a lot of choices from a tax flow standing. Maybe there's some Roth conversions we might look at later on down the road for some R&D planning. But in that sense, we're a little bit more restricted. If we have your non-IRA accounts, brokerage accounts, things of that nature, stock options, things that are outside of that, then we are going to look at the bigger picture and look at what tax brackets you're in today, as well as throughout retirement. And then the biggest trigger for most people is when those R&D start. That's when we're really focused on what we do today at maybe 55 or 60 does have an impact potentially on what happens at 75. Now, again, between now and then, things could change to R&D rules. The tax brackets can change. I always say that the tax brackets are only good until somebody else comes in and changes them. So we can only do, what we know right now. By there. So I hope that answered the question on capital gains. I think a lot of times people think that they want to stay in a 0% tax bracket and not pay any taxes. And that sounds great. But if you're just delaying that and suddenly living off of all of your brokerage accounts so that you pay no taxes by touching your IRAs, at 75, your tax bill could be costly. And so that could be a decision that you make. You could just choose to say, well, that's what I want to do today, recognizing the fact that what that's going to do later on. But most people want to reasonably kind of smooth out that tax curve. So maybe that is living off of some capital gains tax right now, so you can do some Roth conversions to minimize those R&Ds, or again, kind of figuring out what is our ultimate goal. Are there certain assets we want to leave behind as well too? That comes into play on how we choose to spend down those assets as well too. So again, I talked a little bit about the R&Ds. So for most people, if you're born before 1960, 73 is that. And if you're born after 1960, 75, one of the things to keep in mind is that these are based upon your ownership of your account. So you as the account owner, this is on your own age, not your spouse's age or anything like that. So if you have an IRA and those R&Ds are based upon your age, if your spouse has IRAs, then they're going to have their own separate R&D schedule as well too. So again, kind of keeping with that theme of the tax planning and some of those withdrawal strategies, right? Everything is taxed differently. So when we're looking at that whole picture, Social Security does get brought back into the picture for all of this. So it is not something that we completely write off. Your pension and annuity income is brought in as ordinary income as well. We potentially have interest if we're doing bond ladders, CDs, money market accounts, things of that nature. All of your IRAs, 401ks, things of that nature are going to be as ordinary income. Dividend income, as long as they are qualified dividends, is going to get taxed at the long-term capital gains rates. So that could be something that we bring into the mix to help manage that situation. Again, long-term capital gains have the more favorable treatment. Roth IRAs are not subject to taxation. A lot of times, Roth IRAs are more of an estate planning legacy type of planning. We're not usually bringing in Roths into our cash flow planning situation. And then, of course, liquidating the principal. So if you have a brokerage account and you sell, obviously you only pay taxes on the capital gains here. So this is the overall mix that we're looking at. So remember when I said we put the plan together, The plan says, yes, you can retire, but then it doesn't tell you how to do it. So these, when we're thinking of the types of investments that you have, somebody has all of these or a few of these or one of these, and this is what we're going to look at when we're creating that investment and withdrawal plan for them. So we are going to be more of the tax optimization to smooth out that curve over your retirement. So again, I'll talk a little bit about the reviewing and kind of monitoring and what that situation looks like here. Part of the things that we want to monitor is we want to monitor any of your assets. So not necessarily your portfolio, but your assets, your home, anything of that nature that we can bring into the analysis. When we do a lot of this planning, unless somebody has rental property or their home that they plan on selling to bring into the portfolio, we're typically not going to be using their home as a solution to help fund your retirement. You obviously make adjustments to your income if your part-time work started or you didn't do part-time work when we thought. We're going to be monitoring that income as well as any adjustments that might be made. Spending in the portfolio are going to be the biggest ones. When we review that analysis, we'll look at what the plan said we were going to spend for the previous year. And let's say somebody was going to spend $150,000 for the year and they spent 200, right? So the question would be, was that something that was normal? Was that just your lifestyle? And that's kind of, we misgauged what you were doing. And that's going to be something that's going to be there for a little longer. Or was there a one-time expense? Something came up and that was not a normal year. Very important to figure out what that looks like so that if we need to update that plan and relook at what's going on, very important to get those numbers done. From the portfolio side, what I look at is if we're supposed to have $5 million at the end of year one of retirement and we have more than that, then I look at it and say, okay, well, why do we have more? Did the market perform better or did you just not spend as much as we thought? Or did it go the other way and your portfolio is down? And so the other side of that is you spent more than we planned or the market didn't cooperate. So that's how we kind of look at that. And so the idea of kind of monitoring those things is that if we see a pattern happening, then the earlier we acknowledge that pattern and make adjustments there, the sooner the better. So that if it can continue like that, then that's great, not a problem. But if we do say, look, we can only do this for 4 or 5 years, we can't continue to do this long term, I want to identify that potential issue earlier on so that you have the ability to make decisions on whether or not that's important to you to adjust your overall plan. Again, the withdrawal rate is a function basically of your spending in the portfolio. And as long as we're still within a safe withdrawal rate there, monitor the inflation. Do we need to adjust kind of what we're predicting? Are our costs rising faster there? It's usually not one that I'll typically find that will adjust as much. Most of the time, if inflation is increasing, what we find is that typically the market has done well too. So a lot of times that ends up washing each other out there. Monitoring retirement goals and expectations. Again, if something new comes in as far as what we want to do, then we can add in those options as well too on the plan. So again, the whole idea is to make those adjustments so that we can stay on track, catch trends that are risks to you, if they are risks at all, and making sure that we don't get caught 5 years later on down the road and saying, I wish I would have known that before I would have made some adjustments. And withdrawal strategies and investment strategies can change as well too. Your comfort level with risk could change. The overall market could change to where there could be better options for you to withdraw or investment strategies as well that maybe are new or that maybe you weren't comfortable with the first time. And now we want to talk about those as well too. Remember, I said I like the plan to be flexible so that we can make adjustments throughout as you go through retirement. So a few things, again, emotions, I would say, are the biggest trigger that I have working with people as the market is unpredictable, as everybody knows, and we feel differently about it when we're retired. And so when we're saving throughout that, people, I think sometimes if they see their 401k balance, maybe stay the same, even though the market's down, we have the misperception that, oh, well, I didn't really lose any money, but you've been putting money in, the company's been putting money in, and your account is flat, which basically means that you did lose some money. But mentally, we don't necessarily attach that. So when we go into retirement, that drawdown of our portfolio and the market moving and you having the realization that I'm not adding anything more to it, those emotions can definitely take a toll. So we want to make sure that we understand and recognize those emotions and have the plan align with what your comfort level is. So this is kind of like the cycle of market emotions, right? You're very excited, the market goes up, it's great, and then all of a sudden things kind of go down, right? And then we ride it back up, right, as the market goes up. And so this is just a never-ending cycle. And one, from an emotion standpoint, it's a matter of, does that keep you up at night? Does that bother you? And so we don't want that to happen. We don't want that to bother you. But then the other part of it is that this is just the emotional side of it. There's also the behavioral side of it, meaning that if these emotions finally get to you, then the behavioral side is actually saying, hey, I'm going to get out of the market, or I'm going to make some decisions based upon what the market is doing because of my emotions. So we want to find that right balance and understand what the expectations are of your investments, understand that everything is going to be okay and successful. We just have to stay the course. So very important to manage this. And what I'll find when the market is going through these cycles is that we typically gain in percentages. People say, oh, my portfolio gained 10% last year or 5% last year or whatever it was. But when you lose on the downside, people don't say, I lost 10% last year. They'll say, I lost $500,000 last year, right? So we attach that number, dollar value to it, which then triggers that emotional side of it. And people say, well, you know how long it took me to make $500,000 or whatever number it is. So that's kind of how we start going down that rabbit hole of trying to manage that piece of it there. So the idea is the plan helps give us the comfort so that this becomes much more manageable. And this does come with time for people. The earlier years, I will find that people will be a little bit more uncomfortable with markets, even if they feel really good about their plan. But as you've gone through retirement, this is a much easier piece to manage as well too. Again, everybody kind of knows there's always a reason not to invest or to get out of the market. You can look back at potentially any given year and think of a reason that you should get out of the market. So how will a recession affect my emotions? Kind of the same thing, right? This is just taking that little pretty little emotional chart there and just putting it in a bar chart to see what the market does. And you can see these periods of time where the market has been down, and the good times with the bad times. And so unfortunately, that's what we're trying to manage there for you. So those emotions can lead to all different kinds of things, right? With what you're looking at here, the greed and the fear, right? Sometimes when the market's doing good, we feel a little bit more aggressive. When the market's doing bad, we feel conservative. We don't want the market to dictate what our risk tolerance is. We want our risk tolerance to be what it is through the good and the bad as well too. So again, having that process to kind of define that to help you figure out that, hey, we don't need to be aggressive, right? And making sure that we're okay there. Building a portfolio to give some protection on the downside. So if we know somebody isn't going to be comfortable with that, like kind of figuring out, again, maybe that bucket approach is a really good strategy for them because they know that they have some guaranteed money sitting on the side here so that they don't get out of the market and sell there. And again, kind of like pre-planning, making sure that if you're ahead of schedule, it doesn't necessarily mean that you should spend more. Maybe it means you bank that for a rainy day. So if the market does go down, then you can say, well, I'm good because I didn't spend as much, or I chose not to spend more and just save that money so that if there is a decline in the market, then you were already far enough ahead to keep us in line with our plan. So again, kind of the bottom line through all of that is having a plan and working with somebody who can address some of those needs and concerns there for you. So some of the things to think about of, are you ready to retire, and kind of help start to do that is to, again, start thinking about what your retirement plan looks like for you. What do you see yourself doing in retirement? Understanding the risks associated with that. That's more of our job as a financial advisor to kind of take what your vision is, put it together to help you understand those risks by creating that plan and being upfront with you on that, and then reviewing and monitoring it. And again, part of that is, sometimes we're a therapist to our clients, because as the market is up and down, that emotional roller coaster happens. Sometimes it's just a matter of just picking up the phone and saying, can you just reassure me that everything looks good? Hopefully that reassurance is already there within the planning that we've done, but I know we're always faced with something different in the market. And sometimes just talking people through that, reassuring them with the plan that we did can hopefully give you that peace of mind as well too, that you need. So again, when you think about working with somebody as an advisor, you want somebody who's going to obviously have the experience of the market and all of these risks and how to kind of manage through those varying times of the market and those business cycles. Somebody who's going to discuss these different strategies for you based upon your situation as opposed to a one size fits all. And again, continuing to monitor that as well too. Everybody needs different things from their advisors. So I think the relationship part of it about what that person can give to you, if that's what you're looking for, then that's a right fit for you there. But you do want somebody who is knowledgeable within all of those different areas as well too. So that is going to be the end of our webinar. I will open it up if anybody has any other questions or things like that. I don't see anything in here right now, but I will leave it open for a little while. And if that is it, I will thank everybody for joining us. And if you would like to set up a time, I'm more than happy to meet with individuals. You can visit our website and fill out a contact form or give us a call, and we'll be more than happy to schedule that. I hope everybody has a wonderful day. Thank you.